Mr. President, in the last week, I have had people on here that have told me the economy is really resilient and it's in really good shape, and credit spreads. There's really nothing on the horizon that looks bad. It looks like more of the same economy that we had for the past year. Then the next guest comes on and says there are so many signs of a weakening economy and in labor and in people are borrowing more, and the consumer is starting to be much weaker. That's like the next guest, Austin. And then we have Fed people on. On one hand, I hear how restrictive the Fed still is, and we need to cut. And the next guest comes on and says, oh, my God, I can't believe we cut. Inflation is still in the pipeline, and tariffs are coming. We definitely are too easy. I don't know. I mean, it's amazing where we are right now. Can you tell me the answer to both of those questions?
First of all, you better check your booking agent, because it depends who you bring on. The economy's huge. If you're a pessimist by nature, for sure you can find things that will make you more pessimistic. If you're optimist by nature, there's a lot in the hard data that's strong. This is why it's not an easy job to be central banker. You got to, what keeps you up at night? Your job is not to sleep at night. You got to think through every scenario. I still think the economy is resilient. And if we get past this bumpy period of some uncertainty, I still think that when the unemployment rate and the job market are settled in at what looks like full employment, if we can continue to make progress on inflation over the long run, I believe that rates 12 to 18 months from now will be lower than where they are today. And if you look at the dot plot, that's still the general sentiment of the whole committee. But when you have uncertainty, it's like I say, I'm in the data dog caucus. There's doves and hawks and other birds, but I'm with the dogs. And the first rule of the dogs is there's a time for walking and there's a time for sniffing, and we need to distinguish which is which. When there's uncertainty, that's the time for getting as much data as you can and sniffing around. But
where dogs sniff all the time. Why did you have to?
Joe,
I don't know why he. First, it's the parachute and the. Okay.
Look,
they sniff each other's butts.
You, Joe. Look, I changed the analogy because you didn't like the other one.
Well, now I'm grossed out by the last. I got three dogs. That's all they do is.
Austin, let me ask you this question. Now there's multiple questions about one's views about the policy rate. Normally, I'd ask you, do you think we're going to do a couple cuts this year? And that is my question. But now there's two added questions, which is, what's the timing of those cuts? And why do we get to those cuts in your mind? Do we get there because the economy weakens or because inflation declines? Some combination of both? Can you answer all three parts of that question?
Okay. Each of those is an important question. When there's uncertainty, you got to wait for the dust to just get out of the air. It's hard to see what we're doing because the dust has got to clear. But waiting isn't free in that you gain information, but you lose the ability to move gradually. So I think the longer you wait, the cuts, when they come, are going to be backloaded. And so that's why I say 12 to 18 months from now, I think rates are lower. But in this period right now, we just have to wait. They're calling for big tariffs to come next month. A bunch of countries have said they're going to retaliate. We've got to kind of work through that. We got to think through the tax cut. Is there going to be a major tax cut, or is it going to be smaller than what some of the things that are called for? And as Chair Powell said yesterday, what matters is the totality, all of these things added together. Where the cuts would come from, remember, before we got into this uncertainty, I thought rates would be coming down over this interim period or medium run period because the unemployment and job market look like they're at stable full employment. Inflation coming down to target, I believed, on path to 2%. And therefore, rates would be naturally going toward their stopping point. If you saw a slowdown in the economy, that'd be another reason to cut rates. But on the other side, if inflation started kicking up outside of just the tariffs part, And it started looking like in inflation expectations data, we were not on path back to 2%. Then we would have to revise the story because that'd be a pretty fundamentally different situation.
There's an idea out there, Austin, that you are not a passive player in whether or not tariff-induced inflation is transitory. That it's really the Fed who sets the preconditions to it, and the Fed is the one that decides whether or not that tariff inflation spreads to broader inflation. Do you agree with that? And are you doing enough now to make it clear to people that you will respond to higher inflation by raising rates?
I don't know that I agree with that. I mean, I think the fundamental thing about whether tariffs impact on inflation spreads out of just the 11% of GDP where the tariffs might apply to, that is fundamentally an economic question, not a Fed question. That's why I'm out talking to executives in the region, and the other people around the FOMC table are out talking to their contacts to figure out if they apply to intermediate goods, how much of these cost increases are going to be passed through to consumers? How much do the executives think the consumers will bear, or will they push back and they'll have to eat it themselves? That's the fundamental, to me, question about tariff inflation. The commitment of the Fed to make sure that we are on path to get back to 2% is complete and total, rock solid. I believe that when you saw inflation, actual inflation, get almost to double digits, and the long-run market expectations of inflation remained very solidly anchored at just about the announced Fed target, that was a sign of credibility. If you see those market expectations, long run, start rising, and they do not point to to inflation getting back to 2%, I don't see how the Fed would not have to act in that. I certainly think that those are critical indicators that we should be watching.